So yes, moving to the third category of depreciation that we have to learn in this part, and that is 32 subsection 1 2a, additional or enhanced or accelerated depreciation. So as I had previously mentioned, this is a depreciation which is available to an assessee over and above the base depreciation. And for this additional depreciation to be available, the assessee should have chosen WDV as the base depreciation. So if an assessee chooses WDV as base depreciation and fulfills certain conditions, then the assessee can take an additional depreciation of 20% on particular plant and machinery. So let's check this section in detail. Here are the conditions. Condition number 1. Assessee must be into manufacturing or production of an article or thing or power generation and follows WDV method. So it clearly states the assessee should be into manufacturing or production of an article or thing, or he can be into power generation as well. So the assessee shall be into manufacturing sector or power generation sector, no service sector. Also WDV is followed. Condition number 1. Condition number 2. This depreciation is available only for new plant and machinery. That is, it is available only for this block, not for miscellaneous or building. So only for new plant and machinery acquired and installed after 31/3/2005. That is, purchased and installed after financial year 2005-6. Fine? Easy? Now the third condition, plant and machinery should be an eligible plant and machinery. So there is an eligible criteria for this plant and machinery. Let's check what makes a plant and machinery eligible. What Income Tax Act has done here is, instead of explaining what an eligible plant and machinery is, they put forward what not is an eligible plant and machinery. So whatever you see from points 1 to 5 are not eligible plant and machinery. Everything other than 1 to 5 are eligible plant and machinery. Point number 1. Any vehicle, let it be air going, sea going or road going. So from this block, from our block, one second, take out this category. No vehicles allowed. So first one, no vehicles allowed. 2. No office appliances allowed. Things like printer or an air conditioner for an office, a fax machine in the office, these are not things that are directly involved in production, right? They serve ancillary services to production but not directly involved in production. Same goes for ship, aircraft and transport vehicles. They are not directly involved in production, rather serve an ancillary purpose. Third, plant and machinery installed in a residential building like guest house. So again, an AC in your guest house, in your residential purpose building, a power generator in your residential purpose building, again not serving production, hence not directly serving production, that is hence not eligible. Any second hand or used machinery. Second hand or used machinery, even if used for production, directly used for production, shall not be allowed. This has to be a new plant and machinery as mentioned here. And finally, any plant and machinery for which the whole cost is actually given as a special deduction in any other section. So from section 30 to 37, we'll see different items of deduction, right? So if a plant and machinery has its whole cost being deducted in any other section, say in section 35 or in any other section, that machine cannot be claimed here because Income Tax Act will not allow double deduction. Since that item is already getting 100% deduction elsewhere, it cannot be taken here. So don't by heart these 5 points, apply your logic. Logic number 1, any machine used for any other purpose other than production, that is not directly related to production, then not eligible. That is point 1, 2, 3. Vehicle, office and residential, they are not directly related to production, right? Then second hand or used. Second hand or used are not given an additional depreciation because this additional depreciation is only available in the year of purchase, in the year of installation. That is, in the year it's purchased and put to use, only available in that year. So second hand machinery was already used by some other party and was installed in his premises, and for that purpose that assessee might have taken additional depreciation on that machinery's behalf. This is a one-time depreciation. Okay, this accelerated, enhanced, and additional depreciation is a one-time depreciation. Only available in the first year it's put to use. So second-hand machinery, which might have been already claimed additional depreciation by the previous owner, cannot be claimed again by the new owner. And finally, any plant and machinery for which full deduction is available in any other section. These categories of items are not eligible plant and machinery. Also, any plant and machinery for the purpose of any of these 5 activities shall also not be allowed for additional depreciation. Okay, because it's not actually production or manufacturing of an article or thing. Things like mining of stone, it's not production, it's mining. That activity is completely different. Egg hatching, cutting or polishing of diamonds, construction of building or dams, cooking and food or cooking of food in a hotel. These 5 activities, mining, diamonds, relate them together. Egg hatching and food cooking, relate them together. And building of dams, bridges, etc. They cannot be categorized as manufacturing or production of an article or thing. So any machinery bought for these activities will not be allowed as well. Okay, fine. Now let's check how this depreciation works. This depreciation is not available to power sector if they follow SLM. I had previously mentioned, right? The primary condition is the assessee has to follow WDV as the base form of depreciation. So if a power sector assessee follows base form, then available. But if a power sector assessee follows SLM, not available. So the rate is 20% on actual cost of the asset, and as I said, available only in the first year put to use. It's because of this logic second-hand machineries will not get additional depreciation, because this second-hand machinery has already claimed, it's assumed that it's already claimed this additional depreciation by the previous owner. And here rule of 180 days is applicable. Remember when I said if an asset is used for less than 180 days, you only get half of the depreciation? Yeah, that rule is applicable here. But there's a twist. There's a carry forward happening. There's a carry forward eligible here. I'll show you how it works. I'll give you an example. Take this example. A plant and machinery purchased by the assessee and fulfills all the conditions. General rate is 15%. Enhanced is 20% just for the first year, right? It's only available year number 1. Available only in the year it's first put to use. Okay. So enhanced depreciation at 20%. So total an assessee gets 35%. 15 plus 20, 35% in the first year. That's how it normally works. Say this asset is not used for 180 days. What happens? It's used for less than 180 days. So your general rate and enhanced rate gets cut in half. So 15% will be 15% divided by 2. Yeah. And this will be 20% divided by 2. That is 10%. No arguments there, right? So in the first year, you get a total of 17.5%, right? Now we are going to the next previous year. With respect to enhanced depreciation, you can take the balance which was not claimed in the first year to the next year. So you can take whatever that you didn't claim previously to the next previous year. But for normal depreciation, it's not allowed. I'll tell you why that is. For normal depreciation, you cannot take the 7.5 balance to the next year. Rather, you can take a base depreciation completely of 15% because it's used for the full year. Now I'll tell you why it is. See, enhanced depreciation is only available for one single point of time. That is for the first year it's put to use. So say an assessee with genuine business motives buys a machinery on December 31st. Obviously, he just has 3 more months left, January, February and March in the previous year. So he cannot use it for more than 180 days. But then it was a genuine purchase and the need for purchase only arose by December 31st and he made the purchase then. So isn't it unfair to say that this assessee only used it for 180 days so he can only take half rate depreciation for enhanced? If he had purchased it say 4 months back, he would have got the full enhanced depreciation, right? Right. So just because of that, Income Tax Act said enhanced depreciation being a 1 point activity, you can claim balance in the next year. Whereas general rate, it's not a 1 point activity. It happens every year. So for the same machinery you purchase on December 31st, you get whatever depreciation applicable for that year in that year itself. Half rate depreciation, half of 15, 7.5%. Next year you can take full and the coming years you can take full, right? This is not a 1 point activity, whereas this enhanced depreciation is a 1 point activity. So when we go to the next previous year of 21-22, here you get 15% for general, here nothing because the whole of enhanced depreciation has been taken out. Again in 22-23, you get 15 here again, here nothing. So since enhance is a 1 point activity, you have the benefit of carrying forward whatever that you haven't claimed in the first year due to being used for less than 180 days. Fine? Understood? Clear, right? Very simple. That's it. Let's go to the final section to learn here, that is 32 AD. I am leaving 32 for now because there is nothing much to explain here. It's just based on the example that I had mentioned previously in the important points for depreciation. Here we saw what unabsorbed depreciation is, right? Yeah, right here we saw profit 2 lakhs, depreciate 2.5 lakhs. So set off 2 lakhs from profit and you have zero profit and you have a 0.5 lakhs of balance in depreciation, and that is called unabsorbed depreciation. Whatever depreciation that remains in the account of assessee after setting it off against complete profit. You can set it off in the coming years. That's it. So unabsorbed depreciation, I am not talking much. Now going to 32 AD. That is investment benefit. This is not an item of depreciation. Rather, this is an item in similar nature. Let's check what it is. 32 AD is an investment allowance provided to an assessee who starts a business in certain areas. The areas are notified backward areas of West Bengal, Bihar, Andhra and Telangana. But not any kind of business. This business has to be in the nature of manufacturing or production of an article or thing, just like how we saw in the previous section of enhanced depreciation. But power sector units not eligible. Power sector not eligible for 32 AD. Got it? So pretty simple. An assessee sets up a manufacturing or production unit at any of the notified backward areas of the states I mentioned, and also this production unit was set up after 1/4/2015, that is after the financial year 2015-16, and P&M purchased before 31/3/2020. Okay, so the purchase happened before 31/3/2020, financial year 31/3/2020. So these two financial years are important. This is for starting of business. This is for buying. This is after, it was started after 15-16 or on or after, and this is on or before. That's it. So if this is the case, then for eligible plant and machinery, the assessee can take an additional investment allowance at 15%. Eligible plant and machinery, same as this. Same, nothing much. Exact same. One key point is there is a lock-in period of 5 years applicable here. Also, rule of 180 days applicable. I'll tell you what this lock-in period is. Say an assessee has a business unit in Kerala and Andhra. So Andhra has its additional investment allowance benefit, right? So the assessee decides to purchase two machineries. Two machineries, one for Kerala and one for Andhra. But what he does is, he takes these two machineries and registers it at Andhra office. So Andhra, Kerala. Andhra has 32 AD, right? So for the first year, the assessee registered these two machineries in Andhra, got a general depreciation of 15%, right? An additional depreciation, enhanced depreciation of 20%, right? And finally an investment allowance of 15%, right? This is general, this is enhanced, and this is investment allowance. So he gets a total of 15 plus 20 plus 15, that is 50% deduction in that first year, right? 50% deduction in that first year. Now after taking this depreciation, investment allowance and enhanced depreciation, the assessee decides to send back this item, this additional machinery, one machinery, to Kerala. The only reason why he took it to Andhra was to get this additional investment allowance. Now after he claims it, the next year he sends to Kerala. So that's unfair, right? That's why Income Tax Act said if you buy a machinery and register it in any of these notified backward areas and uses it for investment allowance, then that machinery, it is to be used for at least 5 years in that area itself. Clear? Now that's it, and if all these conditions are satisfied, assessee gets an additional depreciation of 15% on the original cost, rule of 180 days applicable, and carry forward applicable, just like how we saw here. Carry forward also applicable since this is a one-time activity. So that's it. I'm hoping you understood everything in this video. If you have any doubts, please reach out. See you. Bye.